Just another boring start to the week. Whatever are we going to talk about today?
Yeah, there's too much to talk about today. I'm definitely going to feature something. Soy oil. We don't talk about it enough. Is this opportunity? Is this a buy the rumor, sell the fact? How do you handle markets like this? We're going to go over all that. We're not going to recap much because it changes every 5 minutes. We went from 0 to 100 miles per hour. It's creating all kinds of opportunities. We're going to go over all that and more.
Let's go.
Welcome to Hedge Heads, where hosts Jon Prishman and Ryan Tungseth discuss commodity markets, hedging, and anything related to trading futures. Remember, the risk of loss in trading commodity interests can be substantial. These are opinions only and not trading advice. While no one knows where the market's going, they're not afraid to share some ideas.
Well, John, we've had a couple of Mondays in a row. How are you feeling about your Sunday night sleep patterns?
I'm going to need a mental health day here pretty soon. We're in Minnesota, so good news. Paid mental health days here in Minnesota. We talked about how boring the markets were getting. And I also said probably careful what you wish for. And this is the way it goes from 0 to like 100 miles per hour. It's too much to cover. I enjoy these markets. I don't enjoy the reason why they're happening. This happened with Russia-Ukraine too. But as a trader, as a hedger, you have to react to the markets. And we've had more than we can possibly handle. Eventually, it does wear a guy out. Even if you're on the right side, it wears you out. It's just so much to watch. I am definitely Twittered, X, whatever you want to call it. There's too much information. Most of it's terrible. And a lot of hot takes. I don't know. Have you got enough hot takes lately?
I am at the point where I'm completely ignoring X minus the quick scroll just to look and see what I'm only looking at like 5 or 6 people. I should share them sometime, but they're my peeps. I'm not sharing.
And you don't. Yeah, I'm not sharing them with you. You don't.
Mainly because a couple of them might actually be for fading, and a couple are actually for following.
Yep. I haven't put much out on the insider because it's been moving so fast and it's wildly unpredictable. Let's talk about what happened Monday. Beans down 70. I believe it's been said that it hasn't happened since 2009. I was going to check to verify that was true. Large move, but this tells you a lot about the bean markets. A lot of people have different theories. And we talk about this often, the spreads. May, July, the upfront spread for beans is near 20-year lows right now. Not only that, the entire way up, and we're looking at the chart, even though you can't see it, obviously, on a podcast.
We can share it on Twitter.
Yeah, we can. This thing, all the way up, the entire time beans were going higher, didn't narrow, which is pretty incredible considering the amount of money that came into it. What this, long story short, what this tells you is that there hasn't been a shortage of beans. This hasn't been real demand. This has been funds putting money in the market. And when it was all on a Trump tweet of all things about how China's phone call went well and they're going to buy a lot more beans. And they took that at face value and basically bought it every day for the last month and a half. Now, what set it off was the wording from China in the first meeting, which didn't sound like it went really well. This is in preparation for the other meetings. And this is in Paris. So they walked out early, or at least so it was said, or at least it was a short meeting. And then the wording was they are not interested in purchasing more U.S. soybeans. Non-row crops, I believe, was the way it was worded.
They said they were interested in agricultural products.
Yes, like beef, they mentioned by name.
And they specifically said non-soybean row crops.
Yeah.
Was what they wanted.
Yes.
Non-soybean.
In other words, they don't want to buy any more soybeans than they're obligated to, which makes a perfect sense. They just signed an agreement for 25 million metric tons. Why would they go above and beyond, especially with what's going on in the Middle East? Probably not really happy with that either. So the spread was saying we've had plenty of beans around. Money overpowers that, and we've seen this 3 times now in beans, I would say in the last year and a half. The exact same pattern where they pile in and they buy it. This one they bought an incredible amount. Now we'll break down what we think is going to happen, or at least I do. It's now you have all these longs, all their technical stuff probably got tripped, whatever proprietary stuff they're using in their hedge funds and the funds. Now they're probably looking for a way out. We don't know that for sure. Other guys think this is a generational dip to buy. I mean, that's what makes a market. You're going to disagree.
So just a question for you, and we can dive into this a little bit more later, but don't you think, like, in a lot of cases, funds have been positioning for months under, this consolidation market before it goes up? So when you have a spike like you did the last 3 days, that perhaps many of them sold out on Friday in that?
No, I doubt it.
I doubt it? Okay.
We will
just
know,
curious.
We'll know more Friday. When it happens that fast and when you're blindsided by news, you generally don't get out. And the problem these guys are going to have is that it most likely wasn't a real market and they became the market. So when you unwind that, it's very difficult to get out. Now, down 70 cents, didn't follow through much, a little bit at night, no panic selling, but that's a tremendously big move in a day. Option prices didn't jump a lot, which the volatility, they weren't believing this move, but it didn't bounce today. It tried to. It was pretty pathetic, and they're heavily bear spreading. But back to that March, May really quick. The market's been saying, we're at full carry. Please don't bring your beans in. Store them. We don't need them. This spread's very sensitive. And Ryan can see the 5-year chart here. You go back to, when beans were tighter, 2023, 22, and 21. We were at plus 20, plus 30, plus 10 at the very least. This thing's at 20-year lows, which means there's plenty in the commercial channels, thus we collapse. And it's just throw that in the pile of things that are going on. There is a bean quote that I love. One of my favorites was from Trading Places, Dan Aykroyd. He's talking to Eddie Murphy as they're entering the trading building to do their big orange juice trade. He said, 1 minute you're up $500,000 in soybeans, and the next minute, boom, your kids don't go to college and they're repossessed your Bentley, which is exactly bean. I mean, that sums up soybeans so perfectly, and we did see that Monday. So we're more interested in where's the opportunity. If you had been listening to the Insider, and got the Insider emails and gotten the Insider audio, you would have known what we have been doing in soybeans, talking a lot about first May puts, talking about June puts, talking about July puts, and guys, have trickled them on. What does a guy do with it now? Is there room for more puts, more downside? Very debatable. I mean, you have oil, you have diesel up, heating oil, diesel, up 22 cents a day. So you can't say this thing's over. But you're always one Trump tweet away or a policy shift or something, or the straits open, and this would really start imploding upon itself. So is it pulling corn too low? Because now the urea and all that, is that the opportunity? Is this an artificially low pullback for corn, getting way too low? And we're looking at corn calls. Are we looking at bean puts? We're gonna go into all of it.
Personally, I'm watching soft red winter.
Why is that?
Look at Chicago, just for all those things and the actual correlations to oil. I'm not saying there's anything to do yet.
That chart was really popular the other day. The crude oil versus the wheat, and how cheap wheat is relative to crude, the cheapest ever.
Yep. No, obviously there's way other factors than what crude oil does. Factors. But just from a speculation side, I'm interested in watching what wheat does. I would not make a move right here. I'm interested to watch and see what it does.
I think that's a very skewed chart because the biggest wheat moves in 2008 and 2009 just coincided with oil being up $150. At the time, wheat was very fundamentally bullish, like very bullish.
Just giving you a hard time. Yeah. It just happened to match up, and they just happened to match up at Ukraine and Russia.
The lowest. That was more of an artificial spike. Okay. The first one was real, like 2009 wheat. I mean, we could have a whole episode on that. That was where the world panicked and the supply was unbelievably low at the same time, not because oil went to 150. It just so happened to be at the same time. The Russia-Ukraine war was the perception there won't be enough wheat. Very different, but similar. Oil spiking on that as well. So in my opinion, that's a very skewed chart. Let's see the $75-$80 crude oil chart, and let's see how that looks with wheat. It's going to look very different. So you have two enormous spikes in there that really skew that chart. And again, baseball statistics. You can get any correlation to anything you want. What they're saying is if it costs a lot to plant it, they're gonna plant less wheat. I'll believe that when I see it. Honestly, it's just like it's not a correlation in the U.S. This whole if the fuel goes up, we're gonna plant less acres. I'm absolutely in the camp that won't happen until the prices get so bad and the pain's so bad that acres come back. But you throw in the urea.
What about the export numbers and the urea and
that would affect corn and beans indirectly because there would be theoretically more bean acres. And guys are going to debate this. You're going to have this debated into the end of the month. But just if you hadn't got your fertilizer plan, it's very easy to switch to beans. That's the thought process behind that. And then if urea and oil and everything stays up, then we're not going to plant enough beans or wheat or corn, and we're going to have a food shortage. Pretty ridiculous that we've had worse situations in the world and come out of it within a month or two. And generally these spikes are all faded. You never know. This could be a different one. We don't know. But my advice is take it day by day. I have guys calling in 6, 7, 8 times. You probably 9, 10 times a day. Very common to call to check in. 1 minute there's an opportunity, the next minute it's gone. If you call more often, I find that guys line up better with the opportunities that I'm seeing.
Yep.
Where you go back to the markets we had a month ago, you needed to call maybe once a week. But it's not uncommon for guys to call once, twice.
Yeah, I was going to say even a month ago, you didn't have to call once a week. Once a month was plenty.
Yeah, the market wasn't moving. There was nothing. I mean, it was just like watching paint dry. Now there's too many things to do. So soybean oil is going to be, we haven't mentioned that. That's on our radar screen.
Watched it all day today.
They're going to have the meeting the 27th. They're inviting 65 farmers. They're
Saw a little spike on that news.
Yep. And then it faded right away.
Immediately.
They're going to talk, and there's supposed to be an announcement of some sort. No one really knows. But what we're watching is this soybean oil. Is it a buy the rumor, sell the fact? Bean oil does trade like that. So this is, I think we're the highest. The chart I had up, we're the highest that we've been since 2015. So it's been a long time since we've been up here.
You want to talk about the correlation there with crude oil?
Yeah, there's
bean oil and crude oil.
It used to correlate zero, like almost 0%. But there was a slight.
Yeah.
Now with the biodiesel thought that we're going to have all this biodiesel, it correlates very highly. There's not actual correlation yet because nothing's mandated. Not much is mandated yet.
Right.
But again, back to baseball statistics, you could throw up a lot of oil correlations. When oil goes up, things tend to get more expensive. That's like the correlation.
That's news.
Yeah, that should be news. That should go with inflation goes higher when oil goes higher. But what's interesting is with these oil spikes is none of them has lasted very long at all. It slowly worked its way up to $1.20 or $120 in 2008, and the dollar was 72 cents. We don't have that. It's not like that, and that was fake inflation. And when it accelerated to $150 a barrel, it blew up the entire economy and nobody could pay their mortgage. So first you see inflation on oil, then you see the bust. Cattle so far is kind of ignoring it, but we're not seeing it in the box beef price yet. So this is going to affect, I guess we're kind of talking about oil and all these correlations. It's obviously going to affect a lot of things. But, if you're long the market, the problem you're going to have is if it gets resolved overnight, or it seems like it's going to, markets are going to plunge. So let's go to your short-term options. Yeah. These are the kind of markets where short-term options can thrive right here. This is where I still like a lot of time, but your short-term, your lottery tickets, call them whatever you want. These are the moves that pay. Now, you obviously have to be on the right side.
This is my time.
Yeah, this is Ryan's time.
And it costs you dearly sometimes.
Yeah, now implied volatility is moving up, so even the short-term stuff, you're not going to get a cheap crude oil call or put.
Oh, you know what? interesting you bring that up. So I actually looked because the April contract had 1 day last week, I think it was. Or no, it must be tomorrow.
1 day options. I like them. I do like those.
I do like them on crude usually.
Yes.
You were like $50 away from the price to even get into a single digit option, like a like for $90.
Yep.
Yeah.
Under $100.
To get under $100, you were $50 away from crude either direction.
That was with 1 day.
With 1 day.
Yeah.
There's some definite volatility in those.
Implied volatility is always high in crude oil. It's insanely high.
Crazy.
Soybean oil also is a market that's insanely high. So if you're a buy the rumor, sell the fat guy, is a guy selling calls. Well, not me. Not in this market. I mean, it's just too dangerous. But you do want to look for those high implied volatility markets, and those are good to sell calls if you can time it, because you get a lot of money, but you take a lot of risk.
Talk on the short-term option, like today, if you're looking at beans.
Yes.
Any of the grains, there's 9 days left because it's a week from Friday. Vol was up yesterday, but it wasn't significant. It wasn't a crazy amount. There was some money to be made just from vol expansion, but it got crushed today.
Yeah, it was. It's not
just because there was not much activity today.
Yeah,
I don't know. So
we got bean puts on it. It didn't perform like you would have thought it would have performed with that kind of move,
which makes me question what might happen tomorrow. But that's why I was watching bean oil today. I think that is a leading indicator right now for where soybeans are going.
They don't know, and I got a little distracted. But quickly, we're going to say, why aren't you guys talking about the like what we should do, what marketing wise in the market? This thing's changing minute by minute. Like, I'm not going to put a recommendation out there.
One, we can't. Yeah, but two, even if we did.
Yeah, well, in the insider though, they might be expecting. Like, you don't see markets like this very often. Like, even on Friday afternoon after the market closed, it looked like beans were going to be up 20-30. Because of the bombing of the island, the Iranian island that all the oil comes from or is distributed from, and then it looked like, then by Sunday night it opened poorly, and then they had China talking, and it completely changed. In other words, it's very hard. My advice to you is, in markets like this that nobody could possibly know where to go, pick your profitable levels. And market on the way up, in a market that's profitable and increasing, pick your levels and do your marketing. There isn't any magic, anything. The only way you can leave the upside open is simply buy puts. As it's going higher, you can't get a guy to catch every wiggle here. It's impossible. The attitude changes so fast.
Yeah, I think markets today, it does do that, but that's where we go back like 2 or 3 weeks, and we're talking about having that plan. And if you saw some of those highs coming in Thursday or Friday, like, you might want to market on some of those.
Yeah.
Corn was surprisingly not super affected by either move, Friday or Monday.
It wasn't, but today was disappointing. But so some of the producers I talked to definitely had their levels in. They got hit. Other guys, were able to price off Friday's close on like some seed bean stuff, and they were able, after the 70-cent move, to price it off, Friday. So my point is, take advantage of all those programs that you can. Have your levels in before this happens, because there isn't going to be anybody that can help you that fast. The market's simply moving too fast and changing too fast, and it's just, you don't get these markets very often. This isn't summer with a forecast shift and you can be confident in your levels and your sales. This changes hour by hour, story by story, and it just when it looks bullish, it got terribly bearish. Virtually snap your fingers in soybeans. Like, you couldn't know that Friday. You couldn't even know that Sunday night this was going to happen. And this is how the market's going to react. It's not a weather market. Very difficult. Those are difficult. So my advice is to have your levels, pick them, be profitable, incremental sales on the way up, and then after all that, look for strategies. Does it make sense to reopen the upside? Which is some of the conversations that I'm having now.
Okay, so let me ask you a couple questions on that then.
Yes.
If you're talking to guys, so let's say you did get puts last week on beans as they went up. What do you? I mean, Probably should have done it this morning or yesterday prior to close. But what do you do with those? Do you hold them for a bit? Let's say they're June or July puts that you got.
Yep.
Do you hold them and that's your marketing, or are you like take some profits now and kind of add it to the bottom line and look at a new spot to re-enter, or what are you looking at?
Guys with multiples, take some off usually. That's usual. And then what's your goal? Is this to really protect beans? Are you trying to make money? And then everybody's kind of a different person. You know what I mean? One guy wants to go for it, and maybe he's a little wealthier, and he's got some money, and he's like, yeah, I have 20 soybean puts on, let's let it ride. Where the next guy's like, I have a couple on, and I'm really happy that I got profits here, and they quickly want to take profits. It's really everybody's own journey. What's my recommendation to them? Well, after I get to know them, most of these guys that have that on, we'll go over, this is the pros and cons of holding. And they're all kind of big guys. They understand that if you hold, you could lose the profit. And then if you take it, you guarantee that profit. But I've always said this is the hardest part of options is knowing where to get out. Not getting in front of a move and being profitable. Some smaller than some bigger. It's that, where do you get out? And a perfect example of this is 2017. I was recommending getting along Minneapolis wheat options. It was burning up. Chicago didn't care. Every phone call from North Dakota and South Dakota and Minnesota was, this wheat's burning up. And we were able to get $750 options on, and it went $3 after that, shortly after that. I had a few on. You know how much I made? $1,500 because there was rain moving in. And I was going to zig and zag real cute like, and of course there was no rain.
I remember that well because I did not get in because I was trying to save half a cent on a limit order.
People do better with my stuff all the time than I do. And other guys wrote it a very substantial amount. We won't get to the exact dollar amounts, but pretty much the whole move. And it was you could see it coming. It looked easy, and guys did it. I'm the guy. It was my idea. And I was the worst out of everybody. Like, I at least got it on. One time I didn't even get them on. I totally forgot to put them on.
I missed it, so I should have listened to you.
Yeah, and it's so that it's not easy. I am one of the worst. As a matter of fact, I'll get guys directed towards it, but I am firmly in the camp. I want the other guy driving to exit because it's very difficult. I mean, I'll give my ideas, but it's one of the hardest things to do.
The hard part for us is that we can't get out first. If you have clients in the same thing, you got to call them and get them out.
Yeah, you can't. It's called front running, and of course, generally it's not going to affect, especially the volumes aren't going to affect the market. But there's going to be firms where it could affect stuff, and in some of the spreads we do, we definitely could affect it. So client has to have a chance at the best prices first. And then you can follow. You know what I mean? You can't know, hey, client A is going to have a huge order. I'm going to get ahead of it. Very against the rules. Couldn't be more against the rules. People have the first choice. That's why a broker can forget to, like, if you call, you're talking to 20, 30 guys and you're all fired up about wheat calls. By the time you're done with it, you might have forgotten about yourself. I know it seems hard to believe. There's positions I forget about all the time.
I definitely forgot to get out of mine after calling a bunch of other people to get out of theirs.
So it gets to be very distracting, but that's just part of the job. I mean, it's my fault. I mean, you can check your account. It's not that hard to do. It's not a very good excuse, but it definitely does happen.
I would say where it more often happens, where it's happened to me, is time.
Yeah.
So many guys want to wait till 12:45 to start moving, and then you're all of a sudden moving 4 or 5 guys out right at that time, and you run out of time to get out of your own.
Now you're talking contract roll day, like March or July. Like, people love to wait. They love to wait till last minute. I mean, that's their favorite move. Let's see how much worse it can get in the next 12 hours. That's that's one of the favorite moves.
It happens to the best of us.
The roll days are, there's something else.
I don't forget myself on roll days, though.
Yeah. But, this market's more than a guy can handle. I enjoy them as far as the markets are concerned. The volatility, it seems to fit me very well. But I am very careful as well, and I pick and choose. Again, you're fighting for 200 to 500 per lot that you're doing, over the last year and a half. Other smarter guys, I'm sure, are just crushing it with, $2,000 gains every time they touch the market. But not here. 200 to 500, and you're going to fight for it. Now that kind of money just falls through the cracks when you have like mayhem. So it's a lot easier to have singles and doubles. And if you're Ryan with short-term options, you could have a home run if you get it right. Never easy in short-term options, but these are the kind of markets that they can thrive in if you can time it. I still err on the side of time. Even the May puts that we have in beans, they're not performing very well at all because they were missed time and it's not enough time. Yeah. Where the July ones are a lot better.
Even the Junes are looking better. But let's talk actually the short-term options because you bring that up. So I was thinking about this today with a few people and just walking through like what it actually means.
Yep.
So the problem with the short-term options is you have like 3 ways you can lose and 1 way to win.
Yeah.
So let's say you bought puts today, you weren't in there for the big move, but you think today's just a coil for a big move down.
Yep.
Right? So I want to get in and hopefully we get another big move tomorrow. That's our 1 way to win. It has to be a big move tomorrow. If it grinds, you lose. Yep. If it grinds slightly higher, you lose. If it's a big jump higher, you lose.
Yeah.
The only way you can win is a fast move down, basically tomorrow or Thursday. So that's definitely the negative. Now, the benefit is they're very reasonably priced, and if it is a big move down, you hit a home run.
Yeah, you get a lot of leverage with very little money.
Yeah, your risk. You have to know the risk profile and what's gonna. You have to know your timing, especially.
Yeah, timing is everything in the markets, and of course, for cheaper options, that's going to be. But if the summer is a good zone when weather changes, that the short term I've seen work very well. Yeah. And obviously things like this over weekends, because you don't know the news. Also, this report coming up at the end of the month. All of a sudden, this one gets to be front and center and a very important. The planning intentions report. We talked about straddles and strangles, and is it the kind of report that those can pay? Volatility's picked up. Things have gotten more expensive, so it's not quite the same. It was really cheap before. Now it's getting more expensive. Yeah. But when you buy those, you're buying a put and a call at this. A straddle is right at the money, and a strangle is different strike prices.
A range I think, with the price between them.
Yeah, I'm thinking about it too much. I probably mess that up. But so you're buying a put and call. You're not directional. What you're saying is this is going to exceed the expectations of what the market expects. So let's say you buy a 30-cent straddle on corn because you think that the acres could be lower or they could be higher and corn is going to get killed. You just think it's going to be a volatile report. And what you're saying is whatever time frame you're buying is you think it's going to move more than that in that time frame in the end. But even that day, the day of, you just need implied volatility to pick up to profit. You don't need a 30-cent move that day. So it's an attractive strategy for guys because you don't have to be right. You just have to be right on you think it's going to be a market mover, not the direction. So it takes away the direction, and it's attractive to people because they're like, I love betting on sure things, and it's definitely not a sure thing, but it feels like I can't be wrong on direction. So it feels like that, but you still really got to know your volatility numbers. You got to know your reports. You got to know if it's a good idea or a bad idea. Not too long ago, it would have worked in corn on that big surprise January report.
Yeah. This
one is exactly like that. It's setting up that way, except for I don't like the implied volatility in corn going higher, meaning the option pricing, it's getting more expensive. But it's true mystery around this one, and it should move the market a lot because it's already in a very volatile mood. But, with my luck, it'll be the exact numbers they expect to the tick, and it'll move 1.5 cents in either direction.
It's a high volatility market. You could sell that straddle.
And what would happen if that did happen? They usually put about 1.5, 2 pennies a premium in corn. So 4-cent loss, that's for sure not what you can guarantee. But just realistically, that's the fluff they put in there. And the fluff disappears right away if it's not volatile. So we kind of got sidetracked, but these are markets where that'll work in a lot of different markets. Start pricing stuff. If you think you're going to get a big move in energy, you better break out the billfold there. I mean, it's not going to be cheap to be doing this in energies. It's notoriously expensive the way it is. But if you get into shorter time frames and you have a thought, maybe it works there. Definitely don't get in over your head with any of this stuff. These are all limited risk strategies that we're talking about, and you're going to not want to know what you're doing. It's just ideas in volatile markets that we're trying to get, or potentially volatile markets, and it feels like we're headed there in grains. It feels like they could go either direction, these markets. I'm talking excited because these markets provide a lot of opportunity. You should be talking to your guy quite a bit in these markets. If you want to get involved. Of course, if you don't and you're not interested, you don't need to call them. But you should be talking to your guys. These are the markets where there's opportunity. Again, timing is everything. You got to know what you're doing. You got to be very careful. Calls can work. Puts can work. Obviously, outright positions and of various combinations. But the market's on the move, and take advantage of it for your marketing. Have your orders in like we were talking about. And these are what you're always wishing for. It's just the way it's happening is not a great, not what you're cheering for, but you still have to you have to react to what the market's doing. And there's going to be a lot more days like this ahead of us. Well, maybe not like Monday, but a lot more volatile days.
I was going to say, how many more days like Monday can we take?
Yeah, take it day by day. That's what I'm telling everybody. I've been getting out of the office early when I can, because it's a little bit much. I'm watching every single tick of every day, and eventually it kind of grinds on you. And what I really don't like is Twitter and all these hot takes. Well, I put myself through it. It's like I don't need to read it, but you want up-to-date news that's breaking, and it oftentimes breaks there. But it's overwhelming, and it really is not helpful right now. If anything, it's probably going to make things worse for you. In my opinion, I don't think that you're going to by the time they put it out there, even if it's good information, which it usually isn't, it's going to be late. I still like the numbers, the published numbers. Susan Stroud. Anyway, she put out an awesome chart on the soy oil prices at the Gulf versus all the other competitors. There's great stuff on there. Don't get me wrong, but where everything, like, these markets can wear a guy out, take a break, and just take it day by day, and be very cautious.
Absolutely. You just made me want to look up beans. So the May bean, I guess 1060 or 1050, since they closed at 1056, is like 59, maybe 60 cents for the straddle.
Oh, for the at the money?
At the money straddle.
Yep.
Sorry, the 1160.
How much was it for May?
For May, it's funny. Both the 1150 and 1160 are 59 cents.
Yeah,
because it closed in between those.
Everything's gotten pretty expensive. So you got $1.20. You're buying that for $1.20. Is that right?
No. You can choose. Yeah, total 60 cents. Choose which one you want.
Choose.
You can choose the 1160 straddle, or you can choose the 1150 straddle. They're the same price.
Oh, I got you. I see what you're saying. Yep. But the total cost is 60 cents.
Yeah. Or you can strangle and do the 1160 call and the 1150 put for like 56 cents.
You have to remember, there's somebody selling them saying it's not going to move this, and I'm not worried. I think the volatility, like, that's what makes a market. There's one guy saying, I think it's going to move more than this. And we're starting to spill into more advanced strategies. And this is where you want to get to. You want to have all things open to you. There's a lot to learn about markets. But, even if you're on the edge of like a more advanced strategy, it's like, just take your time, learn about one thing a week maybe, and but it can be very, very beneficial. Again, one guy's selling that, the other guy's buying it, and and one guy's going to be right, one guy's going to be wrong. More often than not, in these quiet markets, the guy selling it has been on the right side. Lately, not so much. The markets are starting to move. I expect that to continue to happen. Personally, I like a limited risk strategy during all this. And then we better spill over into cattle really quick. So cattle's had a nice comeback. I have hedges to get on. Guys want to protect cattle, and I was hoping for a rally. Very hard with the oil price, very hard with everything that's going on, and now we've come back. As a matter of fact, March is ahead of the feeder cattle index. Dare I say we're a little overpriced in front. April cattle's over where the last cash trade was, or so the last cash trade I've heard. So now we have not an underpriced market. We have a slightly overpriced. Some of the deferreds are still under cash. When you look at the like August feeders, normally would be carrying a premium in March. We're not. We're way under right now. But it's gotten a lot better for hedging. So you didn't miss out. If you're worried, I see diesel go up 22 cents today. This is going to affect markets, including cattle. I know a guy doesn't want to hear that. I'm not cheering for cattle going down. There's been repeated warnings that there's cracks forming in this bull market in cattle. Whether it's the JBS plant completely out of business, the Greenlee strike now in Colorado, and is that plant ever going to come back? Or are they gonna, is it gonna be done tomorrow with a strike? Generally, they get pretty ugly. I haven't heard the latest on anything. I haven't been keeping up with it. I know the market doesn't care, but the big feedlot going out, it's not perfect. I'm not sure the cattle guy deserves this, but eventually all bull markets must end. So is it going to be the high oil price? Is it going to be the border open? There's enough things going on that you should go over the numbers. You don't have to do it. At least go over the numbers and see if it makes sense for your operation. It's as close to an official recommendation as I can make. Go over the numbers to see if a hedge makes sense.
You don't have any short-term put strategies for me?
Cattle's just, if you're getting feeders and you're protected, you're going to spend money. I'm not a big fan of shorter-term feeder cattle options unless that's the time frame that fits you. You're going to pay up no matter what. No, there is no hot, just cheap market there. Live cattle is, I would say, expensive for, like, you have been able to make money in puts. The windows have been few and far between. So it's better for hedging on the speculation side. You can do it. I mean, it's tougher. One of the recommendations in the Insider, we did it, and it was profitable. But no, nothing cheap there. I see nothing cheap. You're going to spend money to guarantee that you keep this level, but that is the problem. If you're buying expensive cattle, there's not a lot of money left over for protection. But you're getting to where you're seeing enough cracks in the foundation. Other guys will disagree wholeheartedly. They gauge everything off the sale barn pricing. And of course, if I was buying these cattle in the sale barn, I would tell myself they can't go down for 3 years as well. That's what I would tell my wife. When you're doling out this kind of money, it's very dangerous. The numbers might not work for you. You might not hedge, but there's plenty of risk there. At least go over the numbers. That's all I'm saying. This is as much as I've talked about that, and I mean it. It's like this. It's given a couple warning shots here, what it's capable of doing pretty quick. And with this unstable environment we got, money shifting around, just these guys getting, wanting to liquidate their position in cattle, which is substantial, will send it careening down like December. Even if fundamentally it's not the right move, go through the numbers. It makes a lot of sense.
It could look like soybeans.
Yes, soybeans. I got my eye on you, soy oil. I'm watching you. I like that monthly chart. It hasn't been up here. This is rare air up here, and it feels like a lot of hype. But we're going to know March 27th at this big old biodiesel announcement or a convention or whatever they got going at the White House. I think that we're going to get our answer that day. We're going to watch the reaction, and hopefully we can figure something out there. I'm watching you.
Well, let's wrap it up there, John. How do people get a hold of you if they want an actual recommendation?
Yeah, you don't have to be a client of Blue Creek Commodities to call Ryan or I. We'd be more than happy to go over, questions that you'd have on any of this, how to get started, if you're an advanced guy, we'll go over strategies that we're looking at. Love to talk about markets, so don't hesitate to call us. When there's so many phone calls that we're bothered by them, we'll let you know, and then we'll
trust me, we're not afraid to let people know.
We'll get Chat GPT.
That's a joke.
We'll get an AI agent to answer the calls, but up until that day, you can give us a call and we'd be happy to go over this with you. And don't feel like you need to know everything. A lot of guys don't want to start because they feel like they should know everything, or they should know more than they do, and they're just afraid to start. You got to start somewhere. And then the advanced guys, I really like to talk advanced stuff. You get Theta Farmer in here, and he'll get in over your head quicker than you even want to. I love that. He
makes me feel like I'm just starting out.
Yep, and then you some of these guys. There is some big, large traders on Twitter. Every once in a while, you get to see like the old floor guys kind of peek into their world, and it's impressive. Of course, they're not going to tell you what they're doing or give away their edge. That's why traders don't talk online. Why would you? Or very little about what they do. But the little peeks they give you, it's very interesting. If you think you know everything about the markets, there's always someone that knows a lot more than you, and they'll humble you really quick. So I enjoy all conversations. Call us anytime, 218-731-1578.
Thanks, John.
Yep.